Hi, I'm Pete Andresen of Andresen Associates. We are fee-based investment advisors in Salinas, California. And I just wanted to catch up this week about some of the things I've been doing with client portfolios. This video is specifically directed at my clients. Thank you all for giving me a chance to do this. I love immersing my head in a daily dose of amazing economic news. So thank you for making this possible. This week's international investing, as you know, I've been doing some of that in our portfolios. You've probably already seen it in your transactions, and I want to discuss why, and I want to discuss what I'm seeing out there. A little disclaimer though, because that's the way it's supposed to happen. Nobody has a crystal ball. These are my opinions. If you're not my client, these are not investment advisory recommendations in the slightest. The mutual funds I'm going to discuss in this video are not in any way advocated by me. If you're a client, you know if you own them or not. I have no idea if they're going to do better or worse than other mutual funds. And there are many mutual funds that have done better or worse than the mutual funds I use here to discuss examples. Beautiful though mutual funds are. Financial markets can go down, way down. I have no idea where bottoms are or where tops are. In my opinions, in no way guarantee investment success. Perfection is, so far as I know, impossible. One of the themes of this week is that investing into declining markets is always an unpleasant and muddy experience where you never get the correct bottom unless you're lucky, and you never get the top unless you're lucky. In short, you could say that perfection is the enemy of the good, because if you obsess about perfection, you'll never do the investing to attain success. It's just a very turbulent process and blundering, as I wrote. Now, recently, I've been cautiously into international investing with my clients and with my own money. And I'm going to discuss first that we actually are looking at a bull market in China. Charles Schwab has pointed that out over on their page. Inflation continues. This morning, we saw Walmart's earnings get whacked from the impact of inflation. It's gone on a lot longer than expected. I have used the recent upturn to lighten up on energy. We held some energy. We bought it back in 2020, and I'll discuss that. Anyway, working all the way down, we're back to reality and valuation matters. Okay, let's look at that bull market in China. It's true, since March, most of the time, the indexes or indices, I guess you could say, in China have been positive. That doesn't mean they'll stay positive. Now, we are having not even a bull market or a bear market. We're having a decline, but except for the tech stocks that have gotten truly hammered, for the most part, there are many stocks that are down something like 10%. So we have yet to see the decline broaden out. Inflation continues longer than government expected or predicted. This is, at this point, proving the concept that COVID is going to take decades to finally work its way through the American social, political, and economic system. I don't think that the government would have stimulated as much as they did and caused the inflation that's been caused and created the pent-up demand that's obviously on display and the supply bottlenecks, et cetera, were it not for COVID. So I'd say that we are still dealing with the effects of COVID and the effects of the government's reaction to COVID via this inflation. And so far, it's big. And that means that the Federal Reserve must raise interest rates. Tomorrow's the big day to see if they're really, really going to hammer it or just try and hope that we can sidestep a recession. So a recession's out there. It's not a sure thing, but it's looking more and more like it every day. So I used the recent upturn in the US stock market to lighten up on tech, China, and energy. And the reason is that a coming recession, should it occur, is likely to hurt these. We bought energy back around March of 2020, back when people were giving away gasoline on the futures markets. And I have to say, at the time, if you were listening, there was a lot of talk about how petroleum is deceased because of green energy. There was a lot of talk of how the entire petro industry is just doomed. And yet, with the war in Ukraine and with the recovery from COVID, that has not been the case. The money has been awesome. It has outperformed the S&P 500. We didn't hold very much of it, but we held some. And I have lightened up. I have not sold in most cases, but I have lightened up. And the reason I have done that is twofold. Number one, a recession is likely to reduce the demand for energy. And number two, a lot of our Johnny-come-lately mutual funds and index funds have picked up energy now and are buying it. So we don't want to over-allocate to that sector. But that's why you saw that. The other thing I lightened up on is China. And the reason I lightened up on China is that we're about to see the war in Ukraine enter a more difficult phase, in my opinion. I could be wrong, as Russia restricts gas and grain to Western Europe. Russia is going to economically intimidate Europe to see if it can bluff a surrender in the Ukraine. Yes, I'm aware that's obsolete technology, or obsolete terminology. Anyway, there's a lot of evidence that Russia and China are acting like Germany and Japan in 1937 to 1939, the prelude to World War II. I'm hoping we're not looking at World War III. If we are, believe it or not, unless nukes go popping here and there, we are likely to not only survive, but thrive through it, brutal though that is. However, who wants to own Germany or Japan in 1937 to 1939? I don't. So I'm lightening up on China just in case, even though they're having a bull market. An interesting thing, this is a political cartoon in 1939 discussing the fact that both the USSR and Germany invaded Poland in 1939 and divided it between them. And tyrants like to work together. Totalitarian systems like to function in concert. When a wolf senses weakness, all the wolves tend to pile on. If Russia succeeds in Ukraine, Moldova is probably next, and the Chinese are that much more likely to go after Taiwan, which will include the United States eventually. So lighten up on China. So why am I adding to our international investment holdings when we're looking at such turmoil in Europe and we're looking at demographic challenges in Asia and Europe, especially since if you look at the past decade, all those little squiggly lines at the bottom of the graph represent international investments. Now, I am really agnostic in terms of where I think economic growth and investment growth internationally is likely to happen, because the reality is we can't guess. It's unlikely to be happening in indices because there's going to be a lot of economic challenges, but individual stocks are likely to do well. I went back and picked tactics, managers, and proven systems that functioned really well when international investing did well. International investing does well when the dollar is really, really high, which it is right now, when the US stock market has gotten overvalued via an inflationary bubble, as it has right now, and when international investing is artificially low, which it is right now. So the last decade featured Federal Reserve stimulus. Absolutely never seen before, a US government intervention in the economic system of the United States. And the US stock market soared beyond rational bounds. So international investing, look at that. It kind of sucked. Matthew, Asian growth and income. Again, I'm not recommending any mutual funds, but Matthew Asian Growth and Income averaged 3.9% over the last decade, which is just dismal. However, dial the clock back a little bit and you'll see something else, and that is that cautious long-term international investing has been successful. Let's look at Matthew's Asian Growth and Income, which is only an example, not recommending it, can't tell what it's going to do in the future. It did 9.65% annual rate of return, turned $10,000 into $91,972, and that's since 1998. So what? 24 years, which is really within the realm of most of us. Meanwhile, the US stock market had a dismal first decade in the 21st century. And as a result, in the last 24 years, it has only delivered 7.18% or turned $10,000 into $53,088. Couple of lessons there. Number one, international investing can work when it's primed up correctly, and it can work so astoundingly well that the results continue to resonate for decades. The other thing to think about is that the United States stock market can have dismal decades as well. So I don't know where the bottom is here. History backs up our strategy. So I have selectively grown our international holdings. Please call me if you have any questions about that. We don't really know what will happen, but history suggests that there's going to be some themes. And I want to point out it's likely to be turbulent in the short run, especially if that recession does approach. But at any rate, I expect success in the longer term. My perception is that we'll be very happy we did these purchases in 5 years. Meanwhile, it's likely to be exciting. How's that for a nice term? Anyway, enjoy the remnants of July and the beginning of August. May you avoid the wildfires now raging in the Sierras. Stay calm, stay happy, and blessings.